Good evening, ladies and gentlemen. This is Clueless Trading Frank on a monumental day, one of the many monumental days in the U.S. financial market history books, almanac it's going to go into in years ahead. October 10th, 2018, approximately 8:20 p.m. on a somewhat cloudy and pleasant evening here on the New Jersey-New York City waterfront, overlooking the Statue of Liberty and downtown World Financial Center. On that note, full disclosure, this is purely for financial education, not for any solicitation or advice. This session will be recorded, uploaded to the Clueless Trading YouTube channel for later viewing for all other members, as well as anybody who has an internet connection, as I always like saying, who want to understand the realities of what happens in financial markets and a couple of very precise and precision forecasts, thoughts and opinions on individual stocks and on the overall markets. On that note, welcome. So, like I said, welcome to the Clueless Trading Market Crisis Management Center. There's an old saying that I made up years ago on my days on Wall Street, which said every crisis is the same for different reasons. The playbook is always the same when it comes to the financial markets, whether it be the algorithmic high-frequency trading playbook or the human playbook, which is basically euphoria, despair, and in between, we make all the money. That's just the way it happens. So, let us begin. Let's get this thing out of the way. Bring it down here somewhere. And I'll put a couple of notes in there before I start. So let me start off with the notes right here. And we will say reasons, because in life as human beings, we all look for reasons. We always need an explanation for things that are happening. Reasons for market crash or corrective move, whatever you call it. Okay? 1. We have the government bond yields, talked about extensively in previous webinars. Bond yields spike. Emerging markets falling. Their currencies devaluation. Bear with me 1 second. I'm going to get used to this pen. Versus US dollar appreciation. US dollar shoots up when rates spike. Obviously, money gravitates towards higher rates. Then we have Fed chairman hinting, even though I believe it was misunderstood, but hinting at further rate hikes. It acts as a brake on US growth. The reason he did that, stronger inflation numbers. PPI this morning, for example, producer price inflation, cost of goods, cost of raw materials moving higher. Oil is a factor. And the reason inflation is happens primarily the two components. Well, one of the components, the most important component, is wage inflation. So people are getting paid more. Amazon's raising their one of the biggest employers in the United States and in the world, raising their minimum wage. Wage inflation, commodity inflation, which is oil, moving higher. and things of that sort. Further reasons. Everyone got that part, right? Good. Consequences. Velocity. You've heard that term quite a bit for here, and you've heard that on the media too. Velocity or speed of the rate hike. 2.8% on the 10-year to 3.225%. In fact, it went to 3.5% equals, I'll give you an exact number in a second. That's a 16% increase in a few weeks. Scares markets. Bond prices, in this case government bond prices, drop, I don't have the exact figure in my head, by, let's say, by the same 16 to 20%. This number I know, $1.2 trillion loss, that's a negative sign, in bond markets. That's just in the US trillion-dollar market, in the treasury bond market. Causes massive sellouts, just like a stock, just like, when stocks fall, margin sellouts, we can see that. Massive sellouts in both stocks and bonds, because multiple hedge funds hold multiple securities. They hold stocks, they hold bonds, so they got to sell a lot of other stuff to come up with, to cover the margin calls on this $1.2 trillion loss. So if they're leveraged, let's say, even 2 to 1, they got to come up with 0.6 trillion. That's 600 billion to cover their margin calls. Big numbers, big numbers. So that causes the margin sellouts gotta get used to this pen. Okay. Margin sellouts cause huge mutual fund, hedge funds, institutional funds. So I squeeze that in. Institutional dislocations. That's a fancy word for saying liquidations. That's what we're in the midst of right now. Okay? Nothing new, no different than past 2, 4, 6, 10% corrections. Everyone with me so far?
Yep.
Okay, great. Now, the simple stuff, but I got to remind people. Now, markets, for example, the S&P is down approximately 4.5%. Individual stocks, big ones, the big ones, down anywhere from 8 to 15 to 20% in some cases. Okay? So obviously, we're going through what we're going through. Now, saying all that, these are the reasons, by the way. These are the reasons that I explained earlier, are the reason why the markets are getting pushed down. Now, biggest risks to the market right now. We know China trade war. We know that. So that's a tick. We know that. What we don't know, and you guys have heard on the media, and I've talked about it before, is earnings warnings. Due to global supply chain disruptions. Simple English. A large amount of U.S. companies and other companies around the world, we're concerned with the U.S., that's our home, manufacture overseas, primarily in China. So global supply chain disruptions can cause earnings losses, or earnings, not losses necessarily, but earnings misses. So this is the big one that we don't know yet. We got two of them. We got FLR, major industrial company, down 14% after hours right now. We had PPG last night, falling hard. This is serious stuff. These trade wars are no good. They can have massive consequences. I've talked about it before. This is not a joke. What you're seeing behind you, as usual, is the futures. Futures are down about 9.5. They should be down a little bit more. In fact, they should be down lower, and I'll explain all that. And they should open lower tomorrow. Can cause massive earnings misses. This is the biggest danger to the market right now. Because if companies start warning, earnings warnings, then you can expect the markets to go lower. I don't care what you think about anything, but that's a fact. Now, these type of drops obviously have taken a lot of fluff out of the market, but earnings warnings will drive them lower. There's a lot of other stuff, and we don't have the time here. You certainly can sign up for the advanced coaching sessions, learn all that stuff, which are impacting the market. But these are the main things that are impacting the market. And the other part that's impacting the market is that mom and pop is just pulling. This is the retail panic. Mom and pop, this is basically the retail investor, is right now pulling dollars from growth, tech, biotech, mutual funds, and they've been doing that all year anyway, into money market accounts. Okay? I started my career at Putnam Investments in Boston. And trust me, I've seen it all before I moved to Wall Street. So, money market accounts. So, mom and pop is just right now, I'm trying to draw a cartoon face, is just their hair standing out and their eyes are big and they're like, what the hell's going on? Okay? So that's also impacting the markets in a big way because the mutual fund complex is the largest complex that is managing the monies out there, if some of you didn't know. And this is what's going on. So enough of this stuff. We want to move on quickly, but I'm sure everyone has a basic understanding of what's going on. And you just have to look at yourself on people who are not following the charts. They are basically incurring much larger losses than the people who are following the charts. They're making money on tactical trades. They are losing money on buying some positions when we have these flash crashes, and there's nothing you can do about it. That's a fact. So let's get into the nitty-gritty of what's going on here. So we look at some past history. So what the market will do over the next month, over the next couple of weeks, is, let me get into it. There's a whole bunch of things going on here. Big time. Look at this liquidations. Look at these red lines here. I'm just going to enhance them. Look at these red lines. I mean, they are just going higher and higher and higher. Look at this. Right now, as of now, futures volume today, 10/10, right? Today's the 10th, is reaching 3.4 million contracts as we speak right now on the daily. You can see that right there. Look at the date down here. The last time back in February when we had 1,200 point down days at one point, we barely reached, well, not barely, this was way high too, 2.74256 million. Now we are, by the time all said and done, this is 3.37 million. You're talking big numbers, big numbers. Massive liquidation. Part of the reason is more of these funds are more leveraged. Part of it is the blowback coming from emerging markets. Part of it is small and some of the smaller hedge funds concentrated either in bonds or in individual stocks are blowing up as we speak. It's a liquidation phase. Before I go any further, let me just put this in very simple English. Over the next month, not a week, not 2 weeks, but over the next couple of weeks going into next month, we are going to have the biggest, and it's starting now, opportunity to take small accounts into very large numbers. Mark my words. This is not the first time. I know exactly, and the more we go through this, I at least learn more and more. My brain picks up the playbook faster than most people out there. What happened back here, which I kind of called pretty much right, I didn't expect, again, just the way I didn't expect this candle. I expected pullback. I didn't expect this candle. Just the way I didn't expect this candle and this one. But I did say this was the euphoric stage. That's the beginning of the year, by the way. This is the 2nd of January, right there. You're looking at, right there. Please focus. This was when all of you, well, not all of you maybe, but mom and pop and a lot of people were just like, rah, 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 market's just great, you know, nothing but buy, buy, buy. And we were mostly out of many, many stocks, and I was taking it easy. I was putting it out there. You can go check my videos that time to validate my point. Say, be a bit more rational because things are getting way too frothy. And then this happened. These things that you're seeing happening normally happen once a year. But this particular year, it's happened 3 times. So the way I look at it, it's giving you a third opportunity to get into some pretty cheap prices. And I believe some cheaper prices are coming. And if you miss out the run-up that is inevitably going to come, believe me when I tell you, I have nothing to prove. My track record is out there. I am not going to be right on every single 2-day move, but when it comes to the bigger macro moves, my performance record is way up there in the top 2 to 5% quartile. I have a 90 to 95% hit ratio when things get really out of whack, as in predicting what might happen, the follow through. So the way I look at it from a very positive standpoint, and I'm very excited, as you can tell from my voice. Either that, I'm completely, gone crazy, like my good friend Donald likes to say. But every trader has to be a little bit crazy, trust me. But I am more excited because this is giving me a third opportunity to make a mini fortune. But the mini fortune does not come that easy. So that's the playbook we're going to kind of run through. And my ACS students will get the full shebang of how to play this. I'm going to give you the basics here. That's my job on these strategic weekly webinars. And then you guys pick up the pieces and do what you need to do. So the way I look at it is this is going to be the same playbook as this. Oh, let me change this color. And I am excited, trust me. Same playbook as this. And that is exactly what's shaping up here. I would like prices at this point because I protected my portfolio. We did extremely well on 3, 4, 500% type of SPY puts alert when the candle broke on multiple charts. I said, go out there, buy those 284 puts, 281 puts. Boom, they went nuts. One of them went from a buck and change, it went to $7. The other one went from about 2 to 5. The 281s. The 284s went from about $1.90 to 7. You're talking some pretty serious numbers here. But if you don't act, it's the same old story. So bottom line is that nobody survived today's calamity, but you could have actually, believe it or not, come out on the green if you had acted on the tactical chart breakdowns. That's the reason why I post charts. Otherwise, I could just blab around and say, oh, market's coming down, let's do that. No, I put actual charts that you can see. Use your own gut feelings. You guys are smart people. Believe me, I know that. And act on it. But you got to act on it. Because these lottery tickets on the short side with these type of candles don't come every day. Small ones do. We've played those. The futures now are down. We're down about 10. You can see that happening right here. So this is the same book the playbook that's going to get played out. Now, if somebody wants a blow-by-blow trade directional guidance, it's not physically possible for me to give it. I'm going to lay out the big picture. You guys take the baton and run with it. How about that? I think that's good enough that's great enough for what my service offers. Plus the timely updates that I put through all through the day. So what we're happening right now, so you see this big picture here. We'll zoom in now. And this is not hard. What's hard is the execution. What's hard is the discipline of holding. What's hard is the discipline of getting in when these tactical lows come into play. And you're thinking of some perfect moment, the sun's going to shine and there's going to be dancing boys and girls and fairies running around and just landing dollars. No. In order for you all to make some serious dollars, I mean serious, you need to be disciplined. There is always risk involved. This is the big risk-reward play that's setting up. It's going to be fast. It's going to be furious. And they're going to take your profits away if you don't sell. So this is my hypothesis on what is about to happen. We are right now testing this white line here, the 200-day moving average. This magenta line here is your 150-day moving average. What you're seeing in front of you, and I'm going to zoom in. Oh, come on. What you see in front of you right now, that was the highs of the market. I said the market would go to around 29.50. It did. Top of the channel, close to it. Is a automatic short covering bounce. Futures are almost green right now. And it's happening in minutes. And this is a daily chart. I'm not even showing you the 5-minute. This is what's happening on the 5-minute right now. So futures traders are very active. Short covering is going on. We have a short-term double bottom in place at 27.71, which is basically what we are talking about here on the broader picture. This was one of the largest one-day drops for 2018. We made money on those SPY puts and on the SPX puts, the 2800s. Anywhere from 100 to 300 plus %, 400%. Quick, fast, small money gets big. Even one contract bought at $195, you could have sold close to $490. 10 contracts bought at $195, you could have sold it at $5,000 in an hour. That's making money off panic. We have made money off the buying panic. We're making money off the selling panic. So don't keep on repeatedly just like walking away from the market because you're just not feeling good. I mean, I don't know what some of you, not all of you, wait for. Like, always like waiting for a perfect setup and stuff. I don't get it. But I'm not here to change your mind. If that's the way you trade, that's fine. Just use my charts as a guiding tool on reaching those perfect moments. We are basically at one of those perfect moments right now. But perfect moments don't just land you big fat wads of $100 bills. So this is what I'm thinking. This is serious technical damage. No question about it. We lost what, $1 trillion today in the market? Close to it, I'm sure. So that bar is $1 trillion. Most people don't even know how many zeros are in a trillion. So saying all that, the 200-day moving average is not necessarily, I repeat, not necessarily the line on the sand that the market should bounce from. Yes, in textbook, yes, the 200-day moving average, it bounces from and all that stuff. I put out some serious charts at the end of the day with comments. I'm not even going to bother asking, but if you guys haven't looked at those with the comments, then you're just being stupid. That's all. You're just being stupid. Because this could, the worst case scenario, we get some major earnings warning and stuff. We're going to drop to this. Remember, this is the downtrend line. Let me put the whole picture in on the screen. There, okay? So this is 2018, exactly 2018, right? 2018 started here with this green candle. So we have a downtrend line here, which intersects at the screen shaking because there's so much trading going on, as if my screens know it. At 27.23, and that's a good 60 points or so from where we are right now. So that's about 400 points on the Dow. So we got this 400 points on the Dow still. And the playbook. I'm giving you the bearish side first. Here, just to retest the breakout of this massive downtrend line. Now, the breakout of the downtrend line happened there was a multiple breakout, but the real breakout happened on, look at the date below, on the 12th of July at exactly where we are right now. Right there. Everyone see this? Yes?
Yep.
Okay, good. It's all pattern recognition. Easy stuff. Believe me, easy stuff. You want to make it hard? Your brain's going to tell you it's hard. This is easy stuff. So it broke out here on the 12th of July. And this is exactly where we are right now. The 150-day moving average is used by some very powerful hedge funds. I learned that when I worked for a hedge fund for about a year before I became a professional trader and went completely on my own, took the deep dive to write my own paychecks. Basically is exactly where we are right now. It doesn't guarantee that that's where the selling's going to stop, but this is where we are right there. So let me draw this. And this is exactly where we are vacillating. Small candle. That candle's good for futures traders for 10, 12, 15 points, 10, 11 points. Futures were down about 11 points. What was the low on the futures right now? The low on the futures right now was 27.71. It went to 27.86. That's 15 points right there. So some smart guy, a futures trader, just captured the meat in the middle. Probably got about 8 to 9 points right there. His evening's made. So saying all that, let me continue with my thing about the possible repercussions of the further fallout. We got a couple of earnings warning. We heard today, after the market, I knew it was coming. Obviously President Trump, I call him Donald, he's very upset about what's happening. But you can't control it. This ain't Argentina. This ain't Turkey. Turkey's premier shouted at his, when Turkey was falling apart a month ago, he was basically screaming at a central bank governor never to raise rates. But the country only stabilized after they raised rates because their currency was just falling apart. So we can't tell the Fed what to do. Yeah, he expressed his opinion. I think it was very nicely done, where he said, but to say that they've gone crazy and stuff, you got to watch out a little bit, guys, I mean, it doesn't really matter. But markets, I know, don't give a shit, excuse my French, but with the President of the United States of America, the freest democracy in the world, telling the central bankers that they've gone crazy might be a great red meat for the base, but that's not the way to really conduct business. But everyone knows Donald, so they just kind of said, okay, fine. He was going to vent anyway. I knew he was going to vent. Now, is Powell doing the right thing or the wrong thing? Look, I know a lot about this stuff. This is sort of my, I'm a wonk when it comes to all that. If anyone doesn't know what the meaning wonk means, just look it up on the dictionary. He didn't really say that he's going to raise rates. He basically said we are far from neutral. I heard that speech. But the market took it like, oh my God, he's going to go on a crazy rate hike binge. He's not. I think the last thing he wants to see is the U.S. economy demolished. There was a lot of other factors that I talked about earlier on that caused this fallout. Lots of leverage means debt on the emerging market side, currencies moving higher, big margin calls, blah, blah, blah. The whole, confluence of those things caused, and then the hedge funds pushing hard because they're all underwater. All the hedge funds are down, most of them, 90% of them are down underwater for the year, while the S&P is up 8+%. So today was one of the days where a lot of them who were short got part of their money back. That's just the way it works. And this part of this selling is hedge funds pushing hard. Short, 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 little bump, boom, short. But this is why the charts are a beauty, and that's what we're going to walk through, we'll walk into right now. So you have an idea that despite all that noise, all the shenanigans, all the comments from President Trump, which personally I don't think was bad. I mean, he vented. I mean, fine, that's okay. He just can't go any further. He can't be calling Powell, Fed Chairman Powell into his office and say, dude, what are you doing? You can't be doing that. I'm sorry, we just don't do business that way. I've always said, we're not some socialist, communist dictatorship. Neither are we a capitalist dictatorship. So you can't be doing that. Let business, it's free market economics. Supply side economics. So, saying all that, do I think the Fed is going to go on a major rate hike binge? No. So markets always have their hidden reasons why they do what they do. So saying all that, we have a 400-point drop if you want to test this downtrend line. And we can go to 2,700, which is basically another 80 points, which is roughly another 560 points on the Dow, which brings us down to 25,000 Dow. This line here, where we turned big time back on June 25th. June's my birthday. I turned 16 mentally. So 25,000 Dow is this line here, this red line. So you might want to get a third mortgage or a second mortgage on the house and buy the crap out of the market if you go to 21,000 Dow or 2,700 S&P 500. Because the bounce is going to be so severe, you can buy yourself 3 more houses. I've seen it happen way too many times. The sad part is that many of you, I would say majority of you, never, ever, ever take aggressive positions at major tactical lows. Now, saying all that, I don't think we're going to have a bounce. And this is going to be the playbook. But it's going to be bounces are going to be 300-400 points, 300. This was like a huge bounce, 700 points, 800 points. Then we gave back the whole thing in 2 days. It is going to be extremely volatile. So if somebody else comes and asks me, so what do you think of this? I'm going to basically smack them. Because my charts are showing you exactly what is going on, what might happen. But to ask a human being to basically tell you what the algos are going to do over the next 15 minutes is the most idiotic thing ever. But more importantly, my charts actually are showing you what they're doing or before they're going to do something. So those type of silly, juvenile, asinine questions in a heavily, heavily volatile market about to come, which we just started the real volatility today, guys. Today, mark the calendar, started the real structured volatility, not insane, structured volatility of 200, 300, 400 points up and down for the next couple of days going into next week. You want to play these bounces? You're going to be one frigging happy camper. But if you think that it's just going to be a one-way easy ride all the way up, just the way it wasn't here, but huge money was made on these multi-hundred point type of moves before the market stabilized and started to have a multi-day move, is exactly the playbook that's going to happen now. The damage was severe. And our people around you in your neighborhood, your mom, your dad, your grandpa, or whatever, is just in panic, in a state of panic right now. All right, so they're going to call up the mutual fund guys. If not today, they'll call tomorrow. They call up their Putnams. They're going to call up their Fidelities and say, "Hey, please put me in the money market right now. Things are a little bit crazy." That's a human reaction, not a trader reaction. A trader reaction is to get the opportunity to trade. So this is a minus 400 point type of move down here. We could get that, and these are going to be very fast moves. They're going to happen within hours, not over days. Learn from past experience. Past experiences missed means nothing. That means you can learn from them and capitalize on them going forward. Your past is your baggage. Your future are your rewards. Forget the baggage. Screw the baggage. Okay? Just move forward. It doesn't matter what you did before. It's what you're going to do over the next couple of weeks, over the next couple of months, over the next couple of days is going to define you as a real trader. Screw what happened last week, the week before, what you did wrong. We all do things wrong, some less than others. The markets and the algos are designed to make you look stupid. Selling too early, like, oh my God, why didn't I hold on too long? Oh my God, why didn't I sell this? It went down. Demolish the mental baggage, move forward. Seriously, tell yourself that, say a prayer before you go to bed. Be a real tactical trader, for God's sakes. God is giving you, I don't want to be an evangelist here, but the market and God is giving you a chance again to buy into prices you never imagined you could buy, and all within 48 hours. Amazon down 135 frigging points, 1735. Great. Maybe it slips another 40 points, but it's a gift. What's happening? All of a sudden, U.S. companies are saying, oh, it's all over. Nobody's buying from me anymore. It's terrible. Things should stop. No. The bears will convince you that's the case. And if you want to sleep with the bears, good luck. You might not find yourself very uninjured, let's put it this way, the next morning. Be a tactical bear like we did today, like we do so many other days. Buy SPY, SPX put, VIX calls, VXX calls. Some of our members do. And trade it. 10 minutes, 15 minutes, 20 minutes. Don't sleep with them. So, my theory is we're going to go through some major gyrations. This was the first real hit. I would like to see a real double bottom after the initial reflex bounce. Let's say the initial reflex bounce, in simple terms, brings us up to 2,800. Remember, the markets did, after we went through this gyration, the market basically went and did a massive, massive double bottom. The period was first week in February, but the markets hit a double bottom all the way down at the end of March. That's an eternally long time for traders, right? I mean, we get so, all of us, myself included, we get so focused on that 15-minute, 1 hour, like, oh my God, you know, and we forget, like, what might happen after that. I try not to, but many of you do. It's called recency bias. I've talked about this before. What's happening now is what's going to be the world from now on. No, it's not. When you had a bad flu, or you had measles, or whatever, or, you know, some sort of like strep throat, or it's stomach ailment, like food poisoning, and you thought that's it, it's over, like I'm never going to, you know, it's just terrible. And you felt like, oh my God, I'm never going to get better. You got better. It's the same thing with the markets, all right? Unless something fundamentally completely changes, which business-wise, nothing fundamentally has changed. We get a slew of earnings warnings. Yeah, things will really fundamentally change. So this was the big breakout, right? This was the one from, you can see that clearly. Let me just make this, get the broad picture. So here was your big breakout. It attempted a breakout, then it pulled back. But the real breakout didn't come till mid-July, right there. So basically what we were trying to do with this market, we were trying to retest that breakout and hold it, but then it just gave in. So once it gives in, panic completely sets in. Remember, I didn't short those SPY puts in the morning. They were 14 cents, 20 cents. The ones which went to $7. I got in around a little less than 2 when I alerted all of you. And I had a couple a little bit before that. Because I wasn't sure whether the market's going to bounce or not, and I try to do the best for you guys. So I didn't want to put it out there. I even mentioned it in chat. You guys could do it, not a problem. Because my charts are clearly telling you what the breakdowns and stuff, so whatever. And even those ones went up, 200+%, 300%. So bottom line is this is your big breakdown level. Breakout level. So there should be resistance 2,800. So if you just do the math from 2778, let's call it 2780, if we get a sharp bounce, we get 20 points, right? From here to here, we get 20 points. Now we're not futures traders, so we don't, you could get in here right now if you're a futures trader, and you could possibly wake up like 20 points higher at 2,800. Markets will regain back to 2,800. Remember, the 50-day moving average on the E-minis is right now at 2881. Right there. This let me zoom in. Right there. It still hasn't completely buckled in. That's the start of a mini multi-month bear market. I've said this before many times. So right now, we're right there. See this red line here? Right there. 2881. So we are down more than 100 S&P points thanks to today's drop. So the standard deviation away from the highways, I've said this many, many times, right? These are the highways that the market travels in or likes to hug. So now with the standard deviation today alone, in my opinion, is probably -5. That's extreme. That's extreme. If we buckle down and hit that 2720 level, the downtrend line, then the standard deviation is going to be -7. You want to literally like get a 5th mortgage on your house, or if you don't have a mortgage, to freaking get money and have a lot of money and just blindly, but just buy the indices. That's it. The SPY and the SPX. You're going to quadruple, quintuple your money right there within a very short period of time. That's only if we get to these levels. The ultimate level is 2,700. Markets never go in a straight line. If the market is destined to go to 2,700, which is a possibility, ladies and gentlemen, it will happen during earnings season. That means between now and the first part of November. Before that, the markets will attempt to bounce. Those bounces will be about 100 to 200 points. Attempt to get back into these structural channels, right? Remember, this was a consolidation channel. That would be 2818, 2817, and of course the macro channel, the big blue line, the beautiful blue line that comes all the way from the beginning of the year after the crash, right? This macro channel, and that macro channel breakdown, and that's when I shorted the market, 2850, 2850. Around here I shorted the market because the macro channel was holding. So the macro channel is 2850. So if you do the math here, 2780 to 2850 is 70. Is 70. If the market attempts to get back into the channel, and it always does that. Now this is a 4-hour chart. So this is the trader's chart. So 2850. So you're looking at 20 times 50. You're looking at 70 E-minis, which is 560. 500 to 560 Dow points. That, in my opinion, is a possibility on a pullback of these massive panic fears on some good numbers coming out of JP Morgan, starting off on Friday with the bank earnings, telling the world, hey, take it easy, now that everything's falling apart, okay? And a couple of good earnings. A 500-point move from here. Now, what happens after that? We shall see, one step at a time. That's what I always do. That's my MO, modus operandi, right? So I'm not going to sit here and guesstimate that we're definitely going to go back in this channel. No, there's some serious damage been done. And damages get rectified very quickly in these markets. I know that. We have seen that happen repeatedly. But I'm not going to make that forecast yet. These are your intense, massive buying opportunities, 500 points down, that type of stuff, 400 to 500 points down. And in the short term, you can trade the market at will. Use my hour charts, hourly charts, my 15-minute, my 15-minute charts, my 1-hour charts, and that's what we're going to get into right now. So the last look at the E-minis right now, you can see that. Heavy. This type of candle doesn't get negated right away. Last thing I'll tell you, this is similar to this candle. You don't need to know much about technical analysis. You just need to be have some common sense. All right? So this was the second stage of the capitulation fallout. This was, what date was it? 5th of February. Remember it very well. The market still slipped lower before it turned massively from the 200-day moving average. Now that's a positive, that the 200-day moving average is still acting as support. Here it acted as support. You can see that? So that reversal candle, you had to play it literally in 1 day. Big money trade. And then it overshot the next morning, which was the 6th. Sorry, let me see. Here, which was the 7th of February. This was the 6th. This was the 7th. This was the 5th. Right? You could catch these things. You have a screen. You can do it. You're not gonna catch exact tops. You can catch exact bottoms, close to it, but it happens very quickly because when the reversal hammers start of this magnitude, it happens, and we've seen this just in the past couple of days. They're just instantaneous. They stay there for like 10 seconds, 15 seconds. Thank the high frequency trading black boxes for it. That's just the new normal. So you can catch the meat in the middle. Now, once it goes back and hits those trend lines, let's say in this case what do you call it? Trying to enter the channel, the 50-day moving average, you are automatically, even if it overshoots, going to get a rejection. Obviously. There are some traders who walk in thinking that everything is just picture perfect. It's a walk in the park. I show you these levels and you can just trade them. But no, you don't. Because first, they're expecting miracles. Second, they don't want to do any work. And thirdly, they sit around and never buy the perfect moments on these bounces. So it's a beautifully stupid combination of stupidity, in my opinion. And then they complain. I don't really care. We're all grown up adults here. So saying all that, I believe that we are, like I said, we are going to basically move up mostly towards the 2,800 level. If we recoup that, there's going to be a short covering bounce to hit this is the 5-day moving average. That's at 2,845. These are way above where we are right now. In the meantime, I told you what the downside is. Now, let's look at the internals. This is your internals. This internal, generally speaking, if you look at past history, the last couple of times that we got here to these levels, and this is lower. This is at 10.31. Most we got to, this is 8.5, and that was back on the 23rd of March. So once you get to these levels, give or take about 2 days, you start to see the stochastics turn. And that causes the market to move higher. However, and this is something, the most important thing I'll tell you, and please, for God's sakes, listen carefully. Your stows can turn, yet the market can vacillate like a monster, down 50, down 100, up 50, up 100 for a few days, couple of days, while the stochastics are moving higher. What's that term called? When you have a massive gyration market, slightly trending lower, yet the stows are trending higher. What is the term called? And by now, all of you should know it. And that means you stay in the trade and you buy the dips because the internal heartbeat is telling you that the markets want to go higher, even though there is massive volatility in those following days as the market is basing. What is that called?
Divergence.
No, it's not called divergence. It's called positive divergence. But you're right. You got half a point, but that doesn't make you pass. And you know I love you, man. You know you're smart. So, Milan, it's called positive divergence. That's the way there is negative divergence, there is positive divergence. Does everyone understand that? Please tell me if you don't.
Yep, spot on.
Does anyone not understand the meaning of divergence, negative and positive? And here I'm showing you positive divergence. Good. It simply means that prices can be trending lower in between very sharp moves during the day. But the internals are telling you that the so-called smart money or the robotic money is buying. And we do this all the time with stocks too. When I see positive divergences on the daily, I stick with that trade. And I buy the tactical dips. And this is the same thing that will happen in the following days and weeks. More like days. When you get a positive divergence like this, it means that it will throw you off. So the following, each candle is a day. So even though we bottomed here, this bottomed, and this happens with stocks too. This bottomed on this red candle on the 23rd. The following day we were up. Boom, the next day we were down after opening higher. Just gave back everything. This keeps on creeping higher. Watch the bottom. Next day we're down. Next day by the 29th, we are still climbing up, but we made a lower low. CNBC saying, that's it, look at this, oh my God. Your brain is like, just eating you alive, like what's going on, everything's down. So by the time you get that, the so-called major low on this candle, the stows are already about to cross. So you can wait around for that if you'd like, for this cross. And I want to be clear about this. You don't always have to buy the bottom. This cross signifies there is going to be a sustained move. A sustained move doesn't mean it's going to be just like that. a sustained moves is going to be like this. And intraday, it's going to be very choppy. So keep an eye on this. Now, saying all that, this is telling me, given the ferocity of the trading, that we're going to go lower. We're going lower. And that lower could be any of these levels. Like I said, we're slipping lower. We're going to break, in my opinion, we're going to break the 200-day moving average. And I love it. Seriously. Why shouldn't I love it? You got some cash on the side. You're not heavily long. And you could cost average if you are. And if you're not, frigging sell. And I said that if you're on a breakdown, you sell. This is not like the grandpa's market where I like say, oh yeah, everything's going to hold up because it hit this line. No. Trillions of dollars are being sold on a whim, and you think some charts are going to save it? I'm just telling you what will happen. Here we slipped below the 200-day moving average a couple of times. Here we slipped a little bit, but in April we slipped quite a bit. See? We slipped in May below the 200-day moving average. Here, I believe we will slip below the 200-day moving average. And good for you. Should be happy. I don't understand why some people are not happy to see cheaper prices. I want this 200-day moving average violated this week. So that you have a nice move after the middle of the month. Which we always do, right? After the 15th. Earnings on Netflix are coming out. You think, what, the earnings are going to be garbage? They're probably going to smoke the street, in my opinion. Given, especially with these prices, it's really a sliver of good news. The stock will be up $50, $60, $70. The stock was down how much today? 35? It'll get back to 35 in 2 minutes. I just make these things up. It's happened way too many times before. Friggin' stock was down 10% of what? That they lost all their customers? They're not expanding into Asia and India, one of the biggest Bollywood movie market? Come on. Wake up time. So saying all that, we still have a lower to go. So enough of this chart. I know people are bored out of it. Done. Now, let's look at this stuff here. This is serious stuff. This is the ultimate trading chart. And anybody who's not using it, I'll just say it. They're idiots. They're total idiots. I love you all. But if somebody's doing some idiotic stuff and not even trading these type of charts and looking at their whatever charts they're looking at, but not even employing this, they are bona fide idiots and they deserve to lose money. I mean, how much more accurate can I get? I even have arrows saying, okay, if it breaks here, there's a chance we're going to go lower. I shorted the market, not here, at night, at this morning. I did it here, on this breakdown, into the bull kill zone. And yet, it was still a 400% on the SPYs and the SPX puts. Come on. If I did it here, it would be like 1,000% type of day, or more. So there's a little green arrow forming there. This little one, little short covering going on. This is the 1 hour. This is the daily on the E-mini futures. The ultimate trading chart. I post every single day. And I love you all, and that's the reason I'm saying it. If any of you are not tracking this or replicating this on your site, investing.com is free. I know many of you are really stingy with your money, and God bless you for that. No, actually, I'm not going to say stingy people are any good. But it's free. And anyone needs help, I'm here to help. I'll show you how to. It's not rocket science, but I'll help you set these charts up. Or just do a screenshot of this chart. Because this is telling you what is going to happen. Now, this one on the daily is starting to do this mini little crossover. How much more easier can you get? But I have these lines here drawn. That's at 27.65. So if the markets, which is at 27.77 right now, drops another 12 points, I want that to happen tonight when China opens at 9 o'clock. That's another 60 points. Remember, each E-mini or S&P point is roughly 5 to 6, anywhere from 4 to 6 Dow points. I'm sorry, 6 to 7 Dow points. So if it drops from here to here, that's 11 points. That's another 66 points on the Dow. Sure, we can get there. So this chart is like a godsend to you guys, for God's sakes, both on the upside and the downside. I still think we should retest 2764. I'm going to watch the stochastics very closely. I don't use the daily for my trading. However, today I did because of the size of the candle. This size of the candle is almost the size of this, except we're falling from higher levels. Right? So we can go a little bit lower. Just the way these candles are so clean to see what the bounces can be, this is where you make the money. So that's it. Let's see if this starts to turn. However, we will need a sustained turn for a couple of days in between, in between this type of volatility. So don't freak out. Let's take a look at the hourly charts. The hourly chart is just unbelievable. It's just sick. Look what happened. This was today, 9 o'clock, 9:30. I didn't short the market till here, till literally 1 o'clock. When I saw it break this gap level, it was still good for 400%. This move here. So it doesn't matter what level you get in. If you start to see this type of candle, I mean, by now you want to just get in there. 300 to 400%. Oops. Just this move. And if I'd done it here, because I really didn't expect this to happen, but neither do anybody. It's just the nature of the beast. I'm not making any excuses. You would be up 1,000% if first thing in the morning you shorted. But then you wouldn't be holding it all the way down here. I know that because right here at this level, there was a lot of, I want to go up. The market short covering, it needs to go up. And that's what I see on my quad charts all the time on the Algo HFT charts. And I keep on showing it to you guys. Green candles appear. So what do? You're just going to sit there and watch your profits disappear? No. You take it down and then you see the next candle appear. It's only in hindsight that everything is 2020, right? Exactly. So there's a lot of jiggering here at the upper gap fill. But look how precise these things are. That's a gap fill. I said we're going to hit that gap fill. Then they fought around it. Lots of green candles here in the afternoon, like around 1 o'clock. And then it just gave in. And then did this. So now, technically, we are at a pretty strong, on the hourly chart at least, we are at a pretty decent level of a sizable bounce. Second thing you have to keep in mind, I don't want to get into too much, I teach all this on my ACS sessions, is we way down over the Bollinger. Anytime you have a Bollinger shoot, remember the Bollinger ended here. And you just let go well after that. You get a Bollinger overshoot, upside or downside. Most of the Bollinger overshoots, by the way, happen on the downside. You know why? Because people like to panic heck of a lot more than they like to basically panic on the upside. People like to panic on the downside. Because on the upside, they don't panic because they might have a little profit. And they say, oh, it's okay, I made a little profit. You hear people say that all the time, right? You guys do. Yeah, I made some money. Oh, shit, if you made some money, if it went up to 600% and you made 50%, that makes you feel good? It makes me feel like crap. But people like to make themselves feel good by saying, oh, yeah, I made some money, so, okay, great. I'll give you a lollipop. But the thing is that the same thing, but on the panic side, is just like, oh, my God, I just got to go. This is it. It's the end of the world. Armageddon. So Armageddon generally causes a Bollinger overshoot. Anytime, basic technicals, 100% of the time it's correct. You get a Bollinger re-entry. And that's why I'm saying we will bounce very shortly within the next, I would say 24 to 72 hours. I'm not saying 48 hours because 48 hours brings into Friday. There's still going to be a lot of margin calls to take care of. But within the next 24 to 72 hours, and that's when you're going to do your trade setups. And I obviously walk people through it, but you do what you guys need to do, you're going to get that severe bounce. and which you're going to sell. You're going to sell the next gap and see how the market reacts. It's probably going to pull back here, possibly create a double bottom, which would be fantastic. Now, if I knew the market was going to create a double bottom over the next, let's say, 3 to 4 days, that'd be great. But I don't know. I'm a straightforward guy. I don't know. I don't know if it's going to go all the way here, fill this gap, which is going to be huge. That's 100 points. That's 700 points on the Dow. In other words, we would take back everything we lost today. Is it not possible? Has it not happened before? The other thing I forgot to mention to you in my original primers or review on the market is the market sending a very serious message to the Trump administration. Start negotiating really hard or else we're going to blow up the market because U.S. companies are going to get hurt, whether we like it or not. I don't care whose political affiliations or what. I'm just telling you straight out. The supply chain disruption is going to cause big losses for U.S. corporations. And I've always said, and I'll never walk away from it, it's American companies that make America great, whether you like it or not. If American companies are hurting, they're going to lay off people. Their profits are going to hurt. They can't sell overseas because of tariffs. They can't make any of the basic stuff overseas. I'm a big proponent of making America stuff. You know that. But there has to be some business logic to it, not just waving a flag, wearing your MAGA hat and just screaming like, oh, no, no, not that stupid stuff. This is a global economy, whether we like it or not. All right? So, the market sent a very serious message today to the Trump administration that let's get this thing moving. I know we put some rightful pressure on the Chinese, but let's start talking a little bit. Let's stop bad-mouthing. Let's stop name-calling. Let's stop early morning tweeting saying how bad they are. Because or else we're going to fall another 3,000 points and we're going to lose the November elections, whether you like it or not. That's it. It's the economy, stupid, right? Remember? And if people see their 401ks down by 15%, their house prices already started to decline because of rates. Okay? They're going to start rethinking. Farmers are already hurt. Nobody's really benefited from this trade skirmish yet, honestly, other than a few things here and there. Who's benefited? Everybody in American business, all the main business leaders said, guys, we need to take it easy. So this was a serious message that the market sent today. A shot across the bow. What do you say? The shot across the bow? And if the government, the Trump team doesn't listen, it's going to get nasty. Mark my words. Okay? This is what markets do. They send a serious message. Time to wake up. So, do I think that they'll negotiate a good, a reasonably good makeshift deal? Yes, I certainly do think that. So anyway, so that's it. So this is your trading chart on that. Let's take a look at a couple of other charts. So here's your S&P 1 hour chart. Okay, I don't know why it says daily. Oops, it is the daily. See what happens? My head's like all over the place. So the daily, yeah, it's really oversold and stuff, but I'm not super excited that it's really there yet. Right? I mean, look at the size of this candle. Yes, we get a little bounce. This is most probably what's going to happen. We get back towards a 280. It's going to be sellers. It's going to come down here. The ultimate buying opportunity arrives at, and I don't know if it's going to happen, right? Which is around 268, 270 on the SPYs. That is complete pattern completion. And that was the breakout of the initial dragon bullish pattern back in May, right there. when we broke out over that. We broke out, we retested, we broke out, we retested, and we just went. It wasn't every day, but that's what happened, right? We went into the acceleration channel. So in order for this to be fully completed, we need the market to come down here. Couple of earnings warning, couple of a little bit more of these, other situations we talked about. The market gets there real fast. If we get there, we are almost close to break even for 2018. 2018 started at 267.30, right? So if we get down here, that means 2000 will be up 1% for the year. I hope that doesn't happen. It hurts mom and pop a lot more than it hurts traders. They'll be like, what the, you know what? Like, I was up so nicely and look at my statement now. I'm back to even. This markets and all these stocks, they all suck. And they are talking about educated people saying that, and dealt with all of them, believe me, I know. People who are less educated saying that, they'll be just like, this sucks. And human things, it relates into a political loss for the government, for the current regime. And we don't want that happening. We don't want too many hardcore, left-leaning, liberal, socialistic type of business policies coming into November. Yeah, if they win the House and stuff, we don't want the Senate to go all the way. Then it's a disaster. If the House goes towards the Dems and they have a majority, they still won't be able to overturn a lot of the really good things that have happened. But if both houses go, the markets are going to drop really hard, and then it's going to figure its way up if nothing really changes. Some serious stuff going on, guys, okay? So this was your big breakout. We came back and retested it. Now we fell below it. I'm optimistic. I think we pull up. We pull back a little bit. I would like to see a double bottom created over the next couple of days before we make this move here. This was the level where the markets gave in, right there. And why does this say 10-12? 10-10. Yeah, so this is where we are. This is the daily, all right? So that's it. I don't want to, keep on boring people here. This one's a dangerous one. This is your S&P daily that we tracked for so long, right? And we traded it very nicely. This was a consolidation channel, which was supposed to hold its level here at the ascending triangle breakout. This big thing is ascending triangle breakout, right there. And it was holding. This was yesterday. I'm sorry. This was yesterday. 9th was yesterday. We're still kind of up there, holding, and then this happened. So here's the dangerous part about technical analysis. If I was to be a complete technical analysis, we're in no man's land right now. They're in serious no man's land. Extremely heavy McClellan oscillators, like minus 200. I mean, these are like hardcore numbers. And at the end of this session, I'm going to show you a chart which I haven't even updated yet. So we're going to reveal it together. And that is the New York Stock Exchange McClellan oscillator. I swear to God, I left yesterday's one on. I didn't hit the update button because I said I'll do that right on the live webinar with all of you. So we'll see where the freaking McClellan oscillator is at the end of the day. How about that? So this is dangerous. Look at this. It's like straight down. What's here? This doesn't mean we need to like bunker and short everything in sight, because there will be bounces that I've showed you on my previous things, those quick 100-point type of pops, but this is bad. And this is your downtrend line that we talked about. Right there, this one. So I'm going to make this a little thicker so it catches everyone's eye. There you go. And that's at 27.23. All right? So you guys understand what we're talking about, right? Everyone? Yep. And we can trade individual stocks all day long for $2, $3, $4, but you got to be quick. You see how fast they are these days? On the upside and downside? So the reason I'm saying this is because you can't come to me and say, hey, what do you think's going to happen in 3 days? I know what's going to happen in 3 days. If God allows me, I'm going to wake up every morning, provide food for my family, take my dogs out for their poop runs and everything, And I'm going to be in the chat room helping you guys. But aside from that, I will only track my charts and trade accordingly as much as I can. It's going to be viciously volatile. So a simple question like, hey, what do you think is going on? The walk in the park type of question, I would love to answer it truthfully, but I cannot do that. This is your cues, broke down. This is Netflix. It's holding nicely till the final blow came at 2 o'clock. So Netflix, again, if you look at it, would be a screaming buy at 310. Screaming. Like you want to scream, you want to buy, you're going to scream again, then you buy again, and you make crap loads of money. These are broken charts here, technically speaking, right? Look at that. It's holding nicely. There was a nice fat reversal candle at 1 o'clock. This was good for 333, 339, 6 points. Now, you want to be a scalper, you're fine. You got to be quick. You want to put out a sell limit out there. So if it takes it, it takes it. If not, then you manually sell it when it's popping. This is your gap fill. This is it. Now, let's take a look at Apple. This excites me because Apple is a bellwether for the market. The company's done nothing wrong. I love my XX Max, by the way. That thing is so freaking fast. It's got more bells and whistles. I'm like, it doesn't have a home button. So I'm still getting used to it. So I'm still using my 8 Plus. Well, I'm going to have to use both ones. But 8 Plus and kind of getting used to the XX Max. So Apple, definitively, at 215 is a absolute high confidence buy. Here, it's going to be slipping and sliding. Can it turn from here? Sure it can. Why? Because of this. There. 216.83. Right there. This is why I said I'm so excited, and I'm so excited for all of you who have missed out on massive runs on individual stocks. And I'm not saying these runs are going to replicate themselves. I'm simply saying that even if you get 1/4 of that run, you're going to make a lot of money. The market and God is giving us a chance. I'm dead serious, okay? To buy these things we never thought we'd see these prices so quickly. So if they come to you, take them. So Apple is a major barometer of the market. And Apple's got Buffett and Apple's got its buyback program. What more do you need? You don't think Buffett's buying the stock at 250? He always likes pullbacks to buy the stock. You think he's buying the stock at 230? I don't think so. So this is it. This is your buy zone. And if you're going to swing it, you can swing it. You can buy it a month out. End of the year, you can buy it even. And this is another thing I wanted to mention to you guys. If you don't want to go through the craziness of the intraday volatility, which I don't blame anybody. I do it because it's my profession and I got to put this out all through the day for all of you to benefit from. Because we have very fast traders, we have slower traders, we have swing traders, we have all kinds of traders. So members. So bottom line is, let's buy something a month and a half out, month out. You have enough time in your hand. You'll go through all the gyrations and end up in that place you're meant to be. And in between, you can cost average a little bit. That's one way to do it. One of the best ways to do it is to buy the bellwethers, the Apples, the Netflixes, the Boeings, the SPY, the SPX, the Qs, the IWMs. I haven't really traded IWM lately. I'll start posting it tomorrow after this washout. But those would be good things to have and buy time. Buy them a couple of weeks out. Cost average as you need to. If the market does a double bottom, like I showed you, then fine. You can always cost average a little bit. Or if it moves up really quick, 300-400 points, the market takes some profits down. That's one way to do it without dealing with the intraday volatility. Because personally, I hate intraday volatility. It's freaking crazy. Does it allow us to get into some good prices? Sure. But how about when it just takes away our profits in 3 seconds, just when you're about to sell it? It happens to everybody. And especially for non-chart readers, they take their profits away in seconds. Now, if you go on where you're truly dogmatically short, well, I gave you a good reason to be why the lower levels possibly are coming. But I'm basically at this point, I'm certainly not dogmatically short. Market's down 1,000 points in a couple of days. I'm not like, oh yeah, I'm just going to short everything in sight. I'm tactically short with a long bias. So Apple's a good one. The other one is Bowie. Oh, VIX. Let's watch this. So here's your VIX. And if the world was just a completely straightforward, fair place, when it's not, we know that, and the market certainly is not, then we would say, okay, the VIX is definitely going to 26, 29 after this breakout, well above that. But the VIX now is in pretty dangerous territory for people who are buying vol and not selling vol. Because this is the level where everybody, which is looking at the charts, you'd think it wants to go to, but it can very easily do this, and the markets can go up to 300 points, and then make a move higher, pull back a little bit, and then eventually get to that 26 level. And I believe it can get to the 26 level with the markets just going to 2750 on the S&P. That's about 200 points down. The VIX can hit 26. But this is a very clean chart, and certainly track it. No questions on the VIX, right? Okay, good. Now, let me show you, and we're going to unveil it here. Let's do this, guys, all right? This was yesterday's. Looked fine. And that's why I say, day to day, morning you open your eyes, it's a different world. So, bottom line is, 1 second. We have a new member. Who comes in, but I haven't seen him. Nana. N-A-N-A. Okay. So this was yesterday, guys. You ready? Is everyone ready? So this was yesterday. Perfect technical setup for a bounce. You got minus 66, like I told you. You want to buy hands down on these things under normal circumstances. You got a nice little crossover up on the stochastics. This is like a, technically speaking, great stuff. This is moving just the way it was back in March. So, fantastic. And I haven't updated it. So let's see where it landed up. This was minus 66. Deep oversold as of yesterday. Let's go update. Wow. How is this possible? Think about it for a minute. There must be something wrong here. Does anyone see what I'm talking about? The NIMO or the McClellan oscillator actually moved higher. This can't be. 9th of October. Oh, they haven't even updated the 10th yet. The markets got so screwed. See, the 9th of October. I'm like, there's no way. Yet, this was the 9th of October, by the way. This was yesterday. The bounce, where we came back and we went almost even on the Dow. So does everyone understand what I'm saying? So they haven't even updated it yet. And it's 10 o'clock at night almost. Wow. This is 9th of October. Today's the 10th. Because it should be way down. So the systems got all screwed up because they haven't updated it. Anyway, so this was yesterday and it looked terrific. That's the nature of panic capitulations and short-term crashes. It knows no technicals. It's just, at least my charts show you where you can go to, but generally it just happens. Now let me show you another thing here. This is the bullish percent index. I don't show this too often, but certain times of the year I do. And the bullish percent index right now is showing you 50% plus bearish here. See the fallout? This is bullish, New York Stock Exchange bullish percent index. Okay, we are look at the RSI. Now it's 11. Generally, once you get to these levels, you are within days of a turnout. Same thing which matches with our charts. When we crashed and burned back in February and March, okay, the bullish percentage index went to 47 down here. It is still at 50. That's why I'm saying there's a little bit more on the downside left. Do I think it has to go to 47 as a reading? Nope. It turned from 50 back in May. But given everything that I showed you on the other side, the size of the candle and stuff, I would say that this resembles now more than this pullback. So I would say that the bullish percentage index is going to drop precipitously as we get over the next couple of days, if it does, as panic truly sets in. All right, is everyone with me so far on this? So these are very critical numbers, because once you get to these levels, you get vicious bounces. I mean vicious. And if you don't catch them on the lower end, it's just like, that's just like free money given to you and you're just not taking it on those bounces. Let's take a look at the our SPX 533, the swing 533 charts. This is today. We are, we're getting there. This MACD just broke lower in a big way. We are getting down towards the lower end. We are well below support. That was S2. You can see that, S2. Well below that. And bottom line is somewhere in this zone between 2750, 2775, we're going to find a short-term floor on the market. So that's about 100 points or 150 points lower. It could happen before that, believe me. But I'm just giving you an idea. Let's take a look at the weekly to give an idea on the directional bias. Gotta love it. I mean, you're talking about a plunge. Again, the 27, maximum 2700, 2750 would be the lower end of the Bollinger, right? These two blue lines of the Bollinger. I wish I could expand this, but I can't. So this is your lower Bollinger, would be a screaming buying opportunity. In the meantime, the move, this is something I'm watching, the MACD histograms, and don't worry about it too much for people who are not really technically orientated. This is starting to slide. This has gone negative right now on the weekly charts. Not necessarily a good sign, not necessarily too bad, because of the plunge was so hard, it had to go negative. Here we were truly negative on the MACD. So what this is signifying in a way that they were sellers, there was massive capitulation, but there wasn't a whole-scale liquidation from real players in the market. Does everyone understand what I just said? Yes? Like there was massive liquidation, hedge funds and all that stuff, but there wasn't a full-scale, oh, I'm going to sell everything that I own type of situations from serious institutional fund managers and stuff, people who actually own stocks for a long term. All right. Any questions? I'll be happy to answer. What didn't I cover? 1 second. Oh, I want to show you the NQ. This is your NASDAQ, something that we trade quite often, right? The tech stocks and all that stuff. This is your acceleration channel going all the way back to 2016, the elections. We are approaching that level. The 50-week, this is the weekly chart. The 50-week is at 69.23, pretty much around the corner. The trend lines are still very intact on the weekly. Good to go. We have had two of these massive pullbacks in techs, February and in March. You can see that. This is the third one. So unless the earnings come out really horrible for the big tech bellwethers, then we are probably going to bounce off these levels. If not, we are going to really crash and burn around here. It's very hard to tell, because at that point it will be a massive a blowout, and all techs will fall a lot more. But saying all that, the stochastics on the weekly are still pointing down. But here, it also pointed down here and bounced from here. So is it possible that it does the same thing? I have no idea. Any quick questions I can answer before I wrap up? Ouch. Shoulder hurts. Mary?
IWM.
Huh? IWM? Is that what you said? I can't hear you.
Yeah, IWM, you mentioned it earlier.
total breakdown. Lost the 50, like see you later, you know. And you know why? Because IWMs are the most sensitive to rates. Most sensitive to rates. I would stay away from the IWM right now till rates start to stabilize. Remember, the Russell 2000 is domestic, right? It's mostly domestic. They sell domestic. So they are the most sensitive to a sharp rise in interest rates. So look at that. That's a real fugly chart. So honestly speaking, you can go to 150. And that's another reason why the markets also fell apart, because there's a lot of smaller companies, US-based, companies which are on the Russell 2000, all different sectors, who just gave in. So on a weekly basis, it's definitely going down. It's getting very oversold. So it is possible that it reclaims back the 50-day moving average over 159. We shall see. Let's take a look at what it looks like on the daily. On the daily, I would draw this line from a trader's perspective. That's really what we are, and that is right here. And there's your breakout level right there. This line, this should be in white. Pretty simple stuff, but this is such an ugly candle. I would say it stops 158. I'm looking for levels where it can stop. That's what I'm doing right now. It can stop around 155.65 just because of the oversold nature right there. But IWM is not something I would be chasing right now, given the nature of what's happening with the bond deals. If bond deals start to come down, you're going to see IWM rip like a rocket. Now, on that note, let's take a... Anyone else have anything I need to quickly look at? Futures are collapsing right now. 13 points. Good job. Let's do it overnight. I'm serious. So here's your 10-year government bond deal. Believe it or not, it wasn't the reason for anything today other than the liquidation, because it actually is this is a daily chart. 2 days in a row, it was in the red. So you're starting to see a topping process. However, this can be just like a stock, can be also looked on as a bull flag. And if that's a bull flag, then we're going to 3.3%. Boom, one more leg down on the markets. Got to respect technicals. Not what I think, what my opinion is. Got to respect the technicals. So this is still a bull flag. Like to see it go below 3.16 or 17%, or at least come down there. Or best case scenario, retest the breakout, which was 3.12%. Just rounding off the number, 3.12%. That would be beautiful. That means the markets would be up 700 points from here. Yeah, get back everything today. But aside from that, it's still up there. So I wouldn't be dabbling in IWM too much. This is my personal opinion, primarily because of what's happening on the interest rate complex. Okay, that's it. I'm still waiting on that McClellan oscillator to update, and when it does, I'm going to post it first thing tomorrow. I bet you it's minus, 80 or 90, 80 at least. It's like sick. I haven't seen those numbers. So in a nutshell, guys, we are being afforded a phenomenal opportunity. If people are waiting for perfect moments, it's a rolling perfect moment, okay? It is not a one-time, like, okay, that's the bottom. I've shown a lot of bottoms in the market in all these years, but those have been rolling bottoms. And rolling bottoms mean that you have to buy a little bit more, or you just buy original buy that you bought, you hold on to it even if it's down, and then you make a big, big sum of money down the road on that. Down the road doesn't mean weeks and weeks. I'm talking days. Oops. So let's see here what's happening with the... Ooh, there you go. What did I tell you? We broke. Let's have a clap. Come on. Can we clap? No? Did anyone hold the puts a little bit? I mean, I just have few left because this is it. But by the time you wake up in the morning, it might be... It's all over, meaning it's zoop, all the way around. I want this happen. Look, this has happened so many times. Like, it's the reason I'm not crazy. Like, I've seen it happen after hours, like mad demolition derby going on. Futures down 21. NASDAQ futures down, right? Nikkei's down 210, 215. That's nothing. It should be down 400. The NASDAQ is down 70. Means nothing. Let the resets happen while we have our little Sweet dreams. But this is what exactly I was talking about. We lost the 200, and it's a good thing. All right? It's a good thing. And I'm telling you right now, and don't take this lightly, the markets are sending a very freaking serious message to the Trump administration to get their act straight with China, or at least have something positive coming out. We cannot be doing this, or else we will be down here, trust me, and lose the November midterm elections. I'm not kidding. Can't do that. So I think this is the level that we're looking at, guys. Save a few coins, and let's make this happen faster. Get it done with. In the meantime, hide in pot, okay? How about that? Right, Scotty? Hide in pot. And the Neos and that type of stuff. Woof. All right, guys. Everything I talked to you about is happening. This is fast. 26 right now in the future. So we could, if anyone says we can't get this here, what's this number? I got to put this here. Wouldn't it be nice? We were just hanging out and like having a couple of cold beers, glass of wine, doing this. We'll have virtual wine. How about that? Mary, you want to serve some virtual wine? Just kidding. So let's see. Make this thick. 27.23. We get that. 20 points. We could fall 20 right now as we speak. We're down 30. If you're a futures trader, you are just minting money on the short side. I'm going to start trading futures again. But then you guys won't see me in the morning because I'll be so tired. I'll post like 3 charts and say, see you later. Let's see. Look at that. 27.21. All of a sudden, you're going to see this, stops get triggered, and all of a sudden, you're just going to see, it's like puking, right? This was a big puke. This is a little puke. And this is where we're going. Once we get around there, perfection. Prices are just going to be beautiful. On that note, guys, it's always a pleasure having you guys on the webinar. Let's connect tomorrow. This is going to be one of those few opportunities you get this year to make some very, very serious money. I'll try to help as much as possible. I've shown the broader guidelines on what will happen and how you can play it. And just let's make it happen. United States still stands tall. The Trump team has done a phenomenal job in boosting the U.S. economy. There are things that they need to do a little bit more with finesse, and that's just part of the game, right? And that's what's going on. Markets are sending a sharp message, and believe me, they will listen. And on that note, let's catch up tomorrow. Keep watching these futures. We're going to hit this. I literally think we're going to hit it like in the next 20 minutes or so. Have a great evening. God bless you all. Thank you.